we have the housekeeping out of the way, along with some fancy music. Hello, everybody. Welcome to today's webinar hosted by SeedBlink and myself. Before we dive into the topic, a quick introduction for the people who are here on the call. It's myself, Ronald. I'm the regional head for the DACH region at SeedBlink Group, and I'm pleased and honored to have a good friend of mine, Kambis, here in the call. And since he's a jack of all trades and doing so many things in parallel, I'll let him introduce himself.
Thank you very much, Ronald. For those of you who don't know, Ronald and me were work colleagues at one time at one of our companies. So yeah, my name is Kambis. I am the head of startup services and deputy head of founder services at the Austrian Federal Economic Chamber, which is the Chamber of Commerce, where most of the companies in Austria are part of it. I'm in this position for 4.5 years, and I'm lobby actually for startups and founders in Austria, and also involved on the European Union level when it comes to legislation. But apart from that, I started as a startup founder myself. I was active roughly 10 years, particularly in the fields of education, HR, and mobility. And then I moved into angel investing, venture capital investing, which I still do. So I still invest, particularly in pre-seed and seed stage. Yeah, and happy to be part of SeedBlink's webinar now. Also, one of my startups where I am a shareholder actually, and I've invested. Sendence is now running a campaign through SeedBlink. It's a health tech startup. Very interesting, very strong team. So if you're interested, you can also take a look at it.
Cool. Thanks for the intro. And he's downplaying himself a bit because he was also nominated Business Angel of the Year last year in Austria. So one of the 3 competitors, and recently became a writer together with his lovely wife. But apart from that, our today's webinar is about the role of angel investors in startup growth. And I would begin by setting the frame with the old saying that goes, there is angels that have 1 wing and there is angels that have 2 wings. Now, the 1-winged angels are the ones who just provide money, and the 2-winged ones they are providing something beyond money. Now, asking this very particular question to ChatGPT, what angel investors can do in startup growth, it's basically 5 points are listed. Like obviously providing initial funding, providing mentorship and guidance, building some credibility, being a bit more flexible on investment terms like professional investors like VC funds, and obviously supporting scalability. And with that intro, what's your experience as an angel investor, Kambis? What do you bring to the table beyond capital?
Mm-hmm. Yeah, so I believe the role of an angel investor is quite challenging one because it involves more time commitment than just what a standard investor would do. And I think some angel investors, they call themselves angel investors, even though they are not an angel investor, to at least what I believe needs to be done if you act like one. So think about it. If I invest higher sums, then okay, you got my money, 50,000, 100,000, 200,000, okay. But if you invest less, for instance, then I think it can only work if you actually combine it with much more time commitment, because my experience shows the more time you can invest into founders and teams, the more they will benefit, and the more actually they can grow the company. So if you believe you can invest smaller cash sums, and then you're an angel investor without investing time commitment on a larger scale, then I think you don't have the experience, or you have a wrong expectation of what an angel investor is and what he or she is not. And that's what also my experience with my personal startup show. They need your time, they need your expertise. You shouldn't make the decisions for them. That's very important for their own development. But you should be a solid rock for them. If they need support, if they need advice, etc., etc. It's time intensive. So it's not like something, I can just invest into 10, 20 companies and that's it. If you invest directly and not through a venture capital fund, then it will become much time effort you need to invest, because just think about it. If you have 10 startup investments, every week there's an issue with one of the startups at least. Every week there is some kind of contract procedure or some kind of contracts into to check, to write, etc. And then the more startup investments you have, the more actually work you have. So at one point, I think it might be good to have your own team if you act as an angel investor when it comes to a specific amount of investment, or if you want to have less time commitment and less time investment, then just go invest through a venture capital fund. Or maybe like also like a platform like SeedBlink, for instance. But you can also combine it. So for instance, I do all three. So I invest directly, I invest through venture capital funds, but I also use like networks like SeedBlink.
That's very good. And that's because you touched on the topic like ticket sizes. I mean, what's a reasonable ticket size for an angel? That's a classical question. You know, some people will say anything below 25, 50K doesn't make sense. People say 100, 150K. At the end of the day, it's kind of this trade-off. I mean, you want to have certain angels because you think they might help you growing your startup because they are experts in the field. They are opinion leaders, these kind of people, and you want to see them on the cap table. You want to make it explicit, like this person invested in me, regardless of the ticket amount. And that's an argument I see quite often for a comparably lower ticket that you would allow on the cap table. That's the one part, right? The other one.
So let me add something on this. Yes, absolutely. But you need to be aware if you invest less, then the expectation towards you is higher in terms of like when it comes to time commitment. So don't believe you can invest 10,000, 20,000, and that's it because you're not an angel investor and you financial contributor to it, because that's okay. But in the long term, actually, it's just a very small amount. So the expectation will be higher in terms of like time commitment.
Got it. And that's what you hear quite often from angel investors when speaking to them. I mean, it's the mentoring part, it's being the sparring partner, also being sometimes honestly the psychologists, because you're often talking with founders who are on average way younger than angel investors. Angel investors tend to be of certain seniority, on average speaking, because they might have exited their own company. So I think this is the hand-holding part that is often quite important, and it can get time-consuming. I mean, there's people who do this full time, to be honest. Okay, cool. Second point on our agenda is how to attract and engage the right angel investors for your startup. Any best practices from your experience?
Yeah, so let me tell you something in the audience straight. This game of angel investing, venture capital investing, this is a networking game. So the stronger the network, the easier you have access to capital. That's it. So you either are born into this kind of network, you're privileged, or you need to work for it to actually build your network. And when you do a good job, and people start trusting you, then they will tell others about it, and then you will have additional access to capital. So it's very network based. And also what I see, investors, handing over different deals together with other investors they know they've made positive experience. So if you get one investor, a lead investor on board, then he or she will share it with others, and that's how the game works. In the end, you will need to do several different activities. First of all, before reaching out, have a good structure and timeline when it comes to the fundraising round. Think about when do you want to have the money in a bank account, and then do some kind of reverse engineering. So when do you have to start with the material conceptualization, with the contracts, when you need to start reaching out, etc. That's how you can do it. Before you reach out, have the materials ready, which again you will then improve over time with meeting after meeting. You will get feedback and you might improve them as well. But think about what kind of investors you want to have on board. Is it an angel investor, a strategic investor, a venture capital investor, a family office, all of it? Maybe you don't even need an investor right from scratch. You can just, do some kind of bootstrapping, or as I've just recently got to know, seed strapping. So a new trend when it comes to startups, they actually go for a seed funding round, so pre-seed and seed, at least one funding round, and then they use this money to become profitable, so not to be dependent on too much further additional rounds. That's some trends you can see in the data we have. But do it in a structured way. And then when you set up the investors profile, you're going to reach out, and you can reach out directly. Either you can meet them in events, write them an email, LinkedIn as well sometimes. Some are active, some are not, okay? Or you use, again, network. a networking effect. So who do you know in your surroundings who might have access to specific investors? And you would actually combine these different activities to get in touch with enough investors. Sometimes 4 or 5 meetings are enough to get your first commitment, but don't count on this. So it's in the end also a numbers game. I'm not telling you get in touch with hundreds of investors, but even the best performing startups and scale-ups I know, even they had, for instance, 100, at least 100 contacts they made outreaches to, and out of these hundreds, in the end, 5 to 8 actually committed to investing. So it's a numbers game in the end as well.
You mentioned something I've heard now for the first time, seed strapping. I find that very interesting. So bootstrapping versus seed strapping is interesting. Startup industry always finds fancy words for something
all the time.
That the old economy calls different.
How could we continue if we were not like the ones who like create new buzzwords?
But the point that you made with being strong in networking, I think that goes for the whole industry. It's not only an angel thing. I mean, that keeps going until you exit the company. At the end of the day, if you look at our own deal flow, the best deal flow we get from our investment partners, which is mostly VC funds and renowned angels, to be honest. And the seed strapping is interesting in a sense because it's a reflection of the industry. I mean, investors, as far as I can see, or as we as well, they're increasingly looking for viable business models. It's not scale at all cost, hyper growth, just grow the top line, just grow the revenue, but it's like, how do you turn this thing profitable? So it needs to be on the horizon. And that's why the seed strapping, it's fancy word, but it makes sense to me. All right, now lingering on to the next point, what are angels looking for when making their investment decisions? What are your sort of holistic criteria, and maybe even verticals you are more interested in?
I mean, you have the standard factors, which I will elaborate on, and then I will tell you something from our own personal experience, which makes me believe into a team or founder or not. But what you have the let's say the 2 big factors: the team, for sure, particularly the earlier, the more important. So in pre-seed stage, where I am, it's very important. It can be a team, it can be also a sole founder. One thing also maybe important to mention. So what we see in the data is that you have a high number of sole founders, and even VC investment into these sole founders is growing. Not for like a big amount, but let's say 2-3%, which in the past was not a topic for most VCs, but it's changing. So what more and more investors demand, if you even have just one sole founder, you need a good operational core team. They don't have to be official co-founders, but they can be part of your team. So that can also work. And the number of sole founders, by the way, has almost doubled, for instance, in the US in the last couple of years. But yeah, the team. So you would take a look at, okay, do they have all the strengths that are important? Do they have industry background? Is it maybe the second or third startup? Also, let me tell you this. If you have already scaled one company and exited successfully, you have easy access to capital investors. That's it. It's because you have proven it before, and for sure, I trust someone who has proven it before that he or she will do the same thing again. So it's very logical. The second is the market. Is the market, first of all, big enough you're addressing, particularly for VCs? If it's not big enough, not dynamic enough, they will not invest because it's also a numbers game for them. If you have a fund that is 1 billion, they will not invest into a startup that addresses a market that is below 1 billion. So how big is the market? Is it dynamic? Is it growing? And very important, is there a product market fit? So based on my personal experience and also based on data, the product market fit is actually the top reason why a lot of startups fail in the end. I see excuses very often. The market is not ready. It's the wrong country, etc. That's bullshit. That's bullshit, because if it's the wrong market, if it's the wrong country, but so why are you there? So you need to have good market research, understand what's the market need, and you cannot artificially create demand. I know that some people believe it. That's what you can do if you're Apple, but not if you're like a smaller startup with like limited budget. And then you have a combination of 3 factors: the business model, which has actually been an increasing factor in the last 12 to 18 months for investors. So how fast can you actually become profitable, particularly in software space? I mean, if it's hardware or medical, it's a different game. Then is there a USP, a real USP? And we're not talking about a combination of different factors. Do you have a product USP, USP when it comes to the business model, etc., and the traction. So the more traction, the more I can actually relate to it. You are growing, the revenue is growing, you have clients, app usage, whatever. And now tell me the one thing I mentioned before, what I actually have experienced over the last 15 years. For me, for sure, because I'm a pre-seed and seed, the team is the ultimate factor. And when it comes to the team, there's one trait that I take a look at. And the trait is, are they reliable or not? And when I talk about being reliable, I mean, if they commit to something in terms of like a deadline or to do something, do they really execute it on time and in a qualitative way or not? And if I see teams that regularly don't do this, I can tell you already, over a longer period, this company will not become successful. And it starts, let's say, with like handing out a regular investors report, monthly, quarterly basis. If you don't do it because you say, yeah, something else is more important, or it takes too much time, it's bullshit again. Huh? That's just an excuse. So the reliability and the commitment of the team to execute things that have been aligned on, that's something I really take a strong look at. And this is not something I can evaluate from the beginning. It takes time.
Mm. And that's a valid point, because I mean, when looking at the startup stages, the growth stages, I mean, angel investors are oftentimes the first external investors in a startup. So you're inherently talking about pre-seed and seed startups. Pre-seeds are the one who are mostly basically have a good idea and a couple of PowerPoint slides. And at seed stage, you should have proven the product market fit. And that's indeed a hurdle that a lot of startups fail to do. And that's why the team as the ultimate factor, especially in early stage, it makes sense. And I think there's even statistics that underline that point. Now, the way we look at it, or the way I look at it is, and coming from the investment banking industry where I've worked for over a decade, it's very hard to sort of manage returns, be it startup investments or being investments in general. So forget about that, but try to minimize and manage risks. And managing risk means that if we look at the startups, if a startup goes through our DD, is there anything that could turn into a poison pill going forward? Is the cap table too messed up in the beginning? Is that debt equity? You know, these kind of topics. They are very important and often overlooked. But this is actually how you can, in my view, manage it. Again, manage risks, not return, minimize the risks. All right. Now, besides just angels investing by themselves and their money, you increasingly also see angel networks, syndicates of angels investing via a joint entity into certain startups. How do you see those? Is that something you're also involved? I know you are to some extent. Do you see a benefit of investing in a syndicate with other angels, or drawbacks, for instance?
Yeah, straightforward, yes. And it's not just related to angel investing. Actually, I think you see it in like all other stages. Think about politics. Being alone is very difficult. Actually, you cannot execute so much if you're alone. So you need a group of people actually you can trust and you work with, and then you become powerful. And the same is with angel investing and VC investing, because why? First, more capital. You can allocate more capital. Second, more eyes, better due diligence. And third, the networking effect. So getting more deal flow, better deal flow. That's very important, in particular in times of like nowadays, because there's a competition between investors as well. So in order to get the best deals, you cannot do it on your own, all the screening, all the scouting. So you need a networking effect that you get also the better deals. And as I mentioned before, so you see investors, aligning with each other about potential deals, going there and then getting another investor on board as well. And actually they hand over the deals. That's how it works. And that's why I also think angel syndicates are a good approach.
Yeah, we see that as well in our SeedBlink syndicates offer, where we basically provide our infrastructure for angel groups that want to invest in a certain target. And what happens there quite often, I would say 40% of people who are doing the scouting and who you might call lead investors in such syndicates, and 60% who say, I trust this guy, I trust Kambis as the lead investor, I go along with him and I put another 20, 50K on the table. So this is what we see as well. But indeed, the networking effect, again, here is not to be underestimated. And also, the financial firepower, because as an investor, as an angel, obviously in a startup that grows along the lines of what you expected, that really works out, one of the high flyers in your portfolio, you want to stay on board as long as you possibly can. Now, there will come a time when the financial requirements are getting extremely high, and you will get diluted one way or the other. But at least you should aim to stay in the winners as long as you possibly can. And therefore, I think that makes sense. Okay, what are the challenges that you see investing as an angel, and how do you personally navigate them or manage them?
You just mentioned one on your own. You said like what you see is like one investor, one lead investor, the others trust this kind of investor, and that's the thing. So it's advantage, but also a disadvantage. Why? Because there's a lot of trust. That's good. You can capitalize more and more money for investments, but then you also have pressure. So if the startup doesn't succeed, if it's one, okay, but if it's two, three, then maybe those who are not so experienced, they're suddenly becoming more cautious. So that's one of the challenges we have as a leading angel investor, and you should take it for granted, because after 2-3 startups that fail, actually, then there will be already some negative atmosphere, particularly for investors who are not so experienced, who just entered the game and invested into 5-6 startups, which they think is enough. And as we know, also here a numbers game. Not all of them will actually be high flyers. Only, let's say, 2-3, maybe out of 10, for instance. That's one thing. Second, the workload. Can you manage everything? And because people see you as the lead, also, do they expect, for instance, to coordinate everything with them, to share everything in the beginning? Okay, but if you have 10, 20, 30, 40 startups, how are you going to do this on a regular basis? Also, not personally, one thing is, sometimes I even know that this startup could potentially fail at a higher level than others. But for me, it's like if I see the team still has potential, so I focus on the potential of like a product, of a market, of a startup. That can be good, but it can be also like sometimes be, I would say, dismantling actually my logic, even though I'm sure, actually, to some extent, I already know this is quite a touchy subject, and the setup is not actually an optimal one, but the team, the regulatory setup, whatever, etc. I still push it forward because they focus on the potential they can get out of it. It has advantages, but also disadvantages. And also, you need to have one expectation. This takes time. So if you invest, think about 5 to 10 years in terms of, like, depending on the industry and sector, until you get a financial return on investment. Sometimes it can be earlier. I've seen it also after 3 years or 4 years, but sometimes it takes even longer, because if it's deep tech, it's heavy related. The startup takes 5 years until it actually enters the market and then starts monetizing the money. So have the expectation that it's a patience game. You need time. Some will fail, some will actually deliver. And that's something you need to consider yourself, and not giving up too early, because similar to founders who might give up too early, it can be the same with actual investors who are in this game.
Yeah, that's a valid point. I mean, it's a marathon, not a sprint, as it's often said. And if you look at the statistics, and we touch upon the exit point in a minute, but seed investment towards exit, you're talking, I think, in Europe, 7+ years. And I think the numbers have been even increasing, which poses a bit of pressure on certain 10-year closed funds, which most VC funds are. So that's an interesting one. I think one point I wanted to add is the lead investor topic, and you said it, or between the lines a bit. Sometimes follow-on angels in your syndicate might become a bit too dependent on the lead investor and think, I can ask this guy everything. He knows more than the founder, and that's often not the case. So it's a bit of a trade-off and can be a slippery slope, in a sense that I'm a follower in Kambis Syndicate. I just ask him all the questions and bother him with all the things I want to know. This is not what it should be. So it needs to be managed here a bit as well. It's good to have a lead investor. It's good to have follow-on investors. But I think at the end of the day, they should also support the founders and not annoy the lead investor. The reason why I'm saying this, because I have seen it more often. And also, you don't want to put yourself unnecessarily in a liability position as a lead investor. You want to do something good for your follow-on investors and not then basically be thrown legal battles against when a startup fails. I'm not talking theory. These things happen, okay?
Totally. And you think it can be after like 3, 4, 5 investments, okay, but if it's like 10, 20, 30, 40, 50, how can you manage this? And that's why you as a lead investor, you need also to actually give them the right expectation management right from the beginning. And often it works, but even sometimes it still doesn't work. But that's how it is. That's one of the risks.
Coming to our penultimate point, the exits, and my favorite one, honestly, exit strategies and how to manage the party's expectations. And party expectations means investors, early investors versus late investors versus founders.
Yeah, I mean, that's an interesting question because let's make a comparison between the US and Europe. I would say, based on the data and experience, that US is more exit driven when it comes to startups. So actually, startups are founded to exit. That's actually part of the culture. And in Europe, that's also to some extent the case, but sometimes it's being seen more negatively, because is that being an entrepreneur to scale a company and then exit it? I think both is fair enough. You can set up a company, be your own boss, even let's say after 10, 20 years, run a company. But it's also fair if you just want to build it and have as a long-term goal to exit it. It doesn't mean that you just focus on it, but I think that's very valid case. And now, being a startup or founder, for yourself, you need actually an exit strategy. And the exit strategy can also be not to exit, but you need to define it for yourself where you want to head and direct, because based on this, you will actually get the right investors on board. If you get a VC on board, come on, the goal is to exit. The VC comes and wants to exit because there's a business model. They need to make a financial return on investment for the investors. So that's the ultimate goal for them. They want to make you a good company, deliver a good product, but in the end, it should exit. If it's a strategic investor, it might be different. Building up a company, be part of a bigger group of organizations. And with angel investors, it's like both. It can be like, usually, if you're in the startup scene, you would focus also on an exit. But some startups, for instance, turn into an SME with good dividends as well. That's not actually the big majority, but also like in a portfolio, usually also when, for instance, my portfolio, let's say 80% have the focus on scaling and exiting, and the remaining 20% actually focus on actually build up a company and then go focus on dividends as well, which can be good for cash flow as well to reinvest it again into new startups. But first of all, to sum it up, have an exit strategy that's totally valid, and it can also be not exit. But based on this, you will go for the right investors who match actually your vision. That's what I want to say.
No, that's a fair point. I mean, and that's the usual thing when comparing the US and pretty much to the rest of the world. It's not even Europe. But the capital markets, private as well as public, are just deeper and more liquid in the US. That's a matter of fact, because the ecosystem is way more mature. And there is M&A activity, there's more listings on stock exchanges, and so on and so forth. It's just not the case in Europe. Fair enough, deal with it. That doesn't mean there is none. And whenever talking about exit, I think it's also fair to highlight what we mean by that. An exit is essentially a liquidity event which brings the shareholder money, right? That's essentially selling your equity. And a lot of people think when talking about exits, it's the big IPO that we hear from the Klarnas of this world and the DoorDash and what have you. That's awesome, but that's the icing on the cake. That's unlikely to happen, as a matter of fact, especially for European startups. The second one is more often happening. That's M&A activity. You're just bought by somebody, be it financial sponsor, be it a company. You just buys out your equity, happy investors all over the place. But the third one, and that for me is at least a bit underrated or not as often mentioned, is angel investors tend not to sort of be on the cap table until a real IPO or a company sale happens. The reason being, if you're an early investor and the company grows from seed to Series A to Series B, the increase in value might be so attractive for you as an angel investor that you say would be willing to be bought out by real institutional VC money in, say, Series B and make your 10, 20x, and it's perfectly fine for you. You will never read about this in the media because, you know, these are private transactions. But for a lot of angels investors, that is the main exit route as far as I can see. Would you agree with that?
Yeah, I mean, for sure, it would be also like very attractive to have at least two IPOs at one stage, but that's not actually the standard case. Most startups don't reach these states just in quantitative numbers. So yes, actually the secondary is like the one you would go to be bought out by strategic investors, VC investors. They even specialized actually investment vehicles that focus on these kind of transactions when it comes to buying out angel investors, and that can be fine as well. I mean, it still would be good to have, let's say, 1-2 IPOs at one time. Bigger ones would be also nice, but that's not actually the regular case.
Yeah, I can speak for SeedBlink Group. We obviously also run a secondary market platform, which initially we built up for our own investors to make their shares in private company a bit more liquid. But what we have seen over the last, say, 1.5 years, maybe, due to the fact that the exit market is down and everybody's looking for liquidity, like there is a lot of stuff going on in the secondary market. So if you look at our platform, we have secondary shares for Klarna, for Bolt, for Epic Games. There's really a lot going on because it is one of the exit routes, but it's not the most public and prominent one. But there's a lot happening, and the volumes on the secondary market, they are sky high, especially in Europe. Okay, so that was interesting so far, and now we head towards the Q&A session, and we have one question that says, what information do I bring to a successful meeting with an angel in a case where we use product slide deck?
I will try to answer this as far as I can. So first, the question is now, have you already sent your pitch deck to this investor or not? If you reach out, I mean, there are different approaches. You can test it on your own. But if I reach out, I wouldn't send the pitch deck quite right away. But I would ask, first of all, if you're interested, etc. And then if you fix a meeting, then you can ask as well if you send out the pitch deck before the meeting or not. But you will have, usually you would need a pitch deck, a financial plan ready. You will not discuss it right in the first meeting, but you should have it ready because if there's a follow-up, it can be quite fast or early. So you need to have this ready. And depending on the stage of your company and the region where you are, for instance, a business plan, for instance, US is not always like the standard. There is more, you have like the called pitch book, which is like a pitch deck, but with more profound information and so on. But at least the pitch deck and the financials ready. Then think about if you would send out a pitch deck before the meeting or not. It's one thing is who presents it. Are you on your own, or do you go with your co-founder, etc.? You don't have to get with all your team there. Okay, one person is enough. Maybe a second one for Q&A. At one point, if they're interested, we'll get to know the whole team anyway. And then the Q&A is very important, and there you need to be prepared. So you present the primary pitch deck, and then you have extended slides for all the Q&As that comes. For instance, how much money you're looking for, what's the valuation, how did they come up with the valuation, how you want to enter the market, what's the go-to-market strategy. These are all things that will be asked in the Q&A usually, and also some technical part and regulatory part. Also, take a look at this person, the background, where they have investment, get information to understand a bit how they think, how they act. This can also be useful for you in a presentation because, you know, doing fundraising is an own skill. Some people are good in building a product. Some people are good in selling a product, and some people are good in fundraising. So this is a different skill set. So this can be trained as well, so you can get better. You know, for instance, I was quite shy in the beginning when I was a founder, but then actually I trained it, I became better. I got a lot of, let's say, I was rejection, but it got now better. Also think about it in a way. Each meeting is also or has some kind of a learning effect for you. So you have the first meeting, you get feedback, you actually improve your pitch deck and your materials, and then you go to the next meeting. And the more you do it, the better you get. So don't see rejection just as something negative, but something you can take advantage as well, becoming better as a presenter and using it for the next meetings as well.
Yeah. And just one point to add, and you said it already between the lines, is make sure you do your due diligence also on the investor side. Look at their portfolios. What have they done? You might find similarities, or you might find that it's just not a fit for them, and you can basically allocate your resources differently. All right. But the next question is a bit of a longer one. You mentioned the stages you expect pre-seed and seed ventures that you find interesting. However, in some cases like deep tech, the development time from idea to product can be years. When the product is ready to be commercialized by the venture, but the venture is pre-revenue bootstrap, what stage do you consider this to be in? Is it an interesting state financial investor? Question mark.
Yeah, we talked a bit before about deep tech and health tech. So some products take 7 years, for instance, medtech, it's like 7 years on average to commercialize the product because you have like the research, development, the clinical studies, etc. And some investors understand the game in this area and some don't. So first think about if you really want to get everyone on board or those who just understand how this works. Because if you get someone from, let's say, software space and they know just about software, you can make money from day one. That's different when it comes to deep tech. So you need to have someone who have the understanding, the skill set, the experience, and the right expectation for this. Deep tech is growing. You can see it in all the numbers from Austria to Europe to worldwide. And the investment volume is growing. Also, something, for instance, the European Union is working on, and the EIC and European Innovation Council and all the different vehicles, is that actually to get more investors into this is called the term patient capital. So meaning in some areas you need to be much more patient because it takes 10 years until this works. And these kind of startups need more funding over a longer time period until they actually can commercialize it. So yes, there are investors who understand the game, but a lot still don't understand it. But that's something the whole region is working on so that people understand, investors in this area, it's a different game. And yes, for sure, it can be very interesting because deep tech is the area where there's really some kind of technological USP possible with patenting and all the related stuff. And this makes it interesting, but it's not, I would say, the big majority of investors who are into this game, but it's growing.
And it's indeed hard to assign the usual pre-seed, seed, Series A terms. I think what I would look at is how many funding rounds have you done already, what sizes, and what did you achieve milestone-wise? And for a lot of deep tech startups, you can at least broadly categorize into technology readiness level. So that gives you sort of an implicit milestone, which you can sort of grade a startup. That would be my 2 cents. Okay. I'm joining an accelerator 10 weeks that provides financing towards the end of the program. Can I structure a pre-seed round around their deal with them leading it? Question mark. In which case, what could the offer look like from my side to angels I'm discussing with to secure soft commitments until the deadline comes? Question mark. So I guess the question is around, can I structure a pre-seed round around that deal? You're on mute, Kambis.
Sorry. So I would say see this way. So the quality and the popularity of this accelerator is quite important. So if it's, for instance, it's not an accelerator, but let's say Y Combinator, or let's say Plug and Play, these are big names internationally, then it's, then I would say yes. But if it's not that case, then maybe local accelerators who are quite popular in the country region can be also, let's say, to some extent, at least a minor extent, a reason for investors to join as well. Let's say an additional factor, typical to, let's say, public grants. If you know you get public grants, 500K, 1 million, it can become easier to get investors, but it's not like the only determining factor. So unless it's not Y Combinator, Plug and Play, all the big ones, then this will not apply to investors all around the world. But yes, you can combine it for sure. And that's actually what I would do. So if I, for instance, do a fundraising round, let's say as a founder, I would combine and leverage all these different opportunities you have: accelerator, incubator, public grant, investment. That's how you can push it all together. So you go to the investor, you say you have all these programs that already you're part of, you're joining it, and vice versa. You can tell the same to the acceleration programs or incubators or to public grants, because they will also like it if investors are joining it. So that's what I would do. I would leverage it, combine it all together. But again, it also depends on the quality and popularity of these programs.
That's very valid. Okay. So at the end of the day, getting as many eggs into the basket as possible and leveraging each other, because at the end of the day, you need to create some FOMO effect one way or the other, and public money can help and accelerator money can help. Non-dilutive funding is attractive as an investor. Think about it this way. For each euro that I invest as an angel, the company gets 2 euros because it's leveraged by public funding. That's a brilliant deal. And this is how I would sell it, to be honest. And this is how it's often not sold to us as well. Okay. How can you find and reach secondary market opportunities as an angel investor? And I start with this. I would like to start with this one. Go to the SeedBlink platform and go to secondaries market. But that's just one of the methods on how you can access secondary market opportunities. I think it's fair to say that for advanced secondary markets like batches in Klarna, batches like in unicorns, as an angel investor, it's likely hard to get access to it because also there's quite some capital requirements, right? Also, anything below $1 million doesn't make a lot of sense. Talking money, euros amounts. However, it's again the smaller tickets. So the earlier stage investments. I think it's the network again. If you know angel investors that are invested in your startup, in other startup, you can do private share trades at a discount, at a premium. But what's your experience, Kambis? Are you active in the secondaries?
Not so much yet. I mean, there are, let's say, some opportunities there, but it's a growing market. There are specialized investment entities that focus on it, and it's growing. You mentioned SeedBlink, and there are like other investment entities going this way, and I think this will grow. Because think about it, the liquidity, at least now, is not so high compared to some years ago. It might change in the next couple of years because of different policies. But still, you have a lot of investment portfolios where the investors actually cannot reach the return on investment they were looking for, but they want to actually increase the liquidity because they have other portfolio startups which they need to invest again. So what you see is like a lot of bigger investors as well. They don't have the liquidity as before, and then they have struggling startups. So they need to actually reinvest money into the startups so that actually not everyone goes down. So that's why the demand for this is increasing. And I think that's a good opportunity. And just if you type in secondary market for angel investors and so on, you will see much more opportunities than before.
Yeah. And it's also, we see it with our investors, they view it as a portfolio diversification thing. I mean, if you invest in a pre-IPO candidate like Klarna, you'll likely not get a 10, 20x out of this. You probably get anywhere between 2 and 5x, but in a short period of time, which from an IRR perspective is totally reasonable to do. Okay, next question. What is your advice to measure that the product is market fit? In other words, when can you say the product is market fit?
Yeah, I understand this question because I meet a lot of founders actually who are struggling to understand when there is a product market fit. Because first you have like a problem solution fit and a product market fit, which is like next stage. I mean, you need a product is the first thing, at least an MVP or so. But so depending on the industry and sector, there might be differences. What makes sense and what makes not. Think about it. If you're in the medtech space, it's not about like that you can sell just a product to hundreds of customers. They're let's say binding letter of intents, clinical studies, maybe a CE certification or an FDA approval can be already some kind of proof of concept at least, and then to some extent proof of market. But let's say you're in the software space and B2B. For me, the holy grail is if someone, a startup is able to sell the product even before it's finished, maybe in the MVP or prototype phase, to at least 3 pilot customers, who are willing to pay for the product, even if it's not finished. That's for me a really strong customer validation, because it's not official on the market. They're ready to pay, maybe to a lesser extent, but they're ready to pay. And it also shows your sales skills. And if you can reach something like this in the B2B space, then that's for me a really strong, at least customer validation. Maybe not a full product market fit, but that's the basis of reaching this point. There are some calculatory examples as well. You can check it online as well, how you can actually define it per product, per industry, per sector. But for me, in the space of B2B, everything software related, that would be the way to go.
Yeah, and I guess I'd add to that point. it should be really a validation of the product that is bought by customers, real customers. And there is obviously a philosophical question what that means in MRR terms, but what I often see is that startups try to tell me they make certain amount of revenues, and then when asking the question, how much is project related and how much is product related, then they say, well, 90% is project related. They're doing some advisory business to keep themselves afloat. That's fine, but that doesn't really count towards the product market fit. Show me that you can sell the product to customers. I think that's the crucial point. Okay, how long does it usually take to start with fundraising until you finally get the money secured? That's a good one.
So roughly, I would always consider for maybe not so experienced founders 6 months, something around this. I mean, what you also see, a lot of fundings take a longer time. Maybe not pre-seed, but seed funding upwards. So sometimes it takes even 12 months, depending on the size and which market you're active. If you're experienced and have the network, it can also be like 2 months. But I would roughly estimate 6 months, because you need to think about it. What are the other steps? Preparing the material, reaching out to the potential investors, signing the term sheet, which is the basis for the contractual procedure, then the due diligence process, which is 2 to 4 weeks, depending on what kind of investor you're talking, and then the final contractual phase, which again has some kind of feedback loops as well, at least 2 or 3. And then you have like the signing date, and then you will actually get transferred the money. So it's roughly 6 months. That's something I would consider. If your experience is good, it can be less. But in some stages and for some startups, it has even prolonged.
Yeah. And I guess it's also advice to tell people, calculate with a bit of a buffer, i.e. don't run out of money before you basically secured the round in half a year's time, because it's no surprise, or it's not a secret, that the heydays of 2021 and 2022 are over. Since 2023 and up until today, the fundraising market is more challenging from a founder perspective. Investors are more selective, looking for more like financial KPIs. So calculate and plan with a buffer. I guess that's what I tell our startups always. So make sure you're not running out of money and kill your company or downsize it. Okay, any more questions from the audience to Kambis? Now is your chance. Last one, maybe. I don't see any currently, so I guess then we can finish up here. First and foremost, thanks everybody for participation. The ones who didn't join, obviously, as well as the ones who did, will get a recording and a follow-up email from us. Cordial thanks, Kambis, for making yourselves available. Highly interesting, always chatting with you and getting your insights. And looking forward to the next one, and have a great day, everybody. Take care.
Thank you.
Ciao, ciao.